War shakes economies, rattles investors, and sends markets into panic mode. But is that always the full story? In this episode of Consumer Times, we break down exactly what happens to the stock market when the world is at war. From historical examples like World War II and the Gulf War to modern day conflicts, we explore how war impacts market mood, where money flows during crisis, and most importantly, what you as an investor should do. Whether you are a seasoned trader or a first-time investor, this video will help you make smarter, calmer decisions when the world feels uncertain. Don't forget to like, share, and sue when the world goes to war. What happens to your money in the stock market? Welcome to Consumer Times. I am your host Dr. Arun Kumar, and today we are diving deep into the fate of investments when the world is at war. Or war and the wallet. War is one of the most powerful forces on earth, and it does not just reshape borders and governments. It reshapes economies, currencies, and the very mood of financial markets across the globe. When missiles fly and troops mobilize, investors around the world ask one urgent question: what happens to my money? If you have invested in the stock market or are thinking about it, understanding how war influences market behavior is not just interesting, it is essential. Markets hate two things above everything else: uncertainty and surprise. War delivers both in abundance. History is remarkably consistent on one thing: when war breaks out or even looks imminent, stock markets fall, and they fall fast. This is the classic fear trade. Investors do not wait to see how bad things get. They sell first and ask questions later. We saw this during the Gulf War in 1990, when global markets tumbled within hours of Iraq's invasion of Kuwait. We saw it again after 9/11 in 2001, when the New York Stock Exchange lost nearly 14% in a single week, one of the steepest drops in modern history. More recently, when Russia invaded Ukraine in February 2022, markets across Europe, Asia, and India immediately turned red. The BSE Sensex and NSE Nifty 50 both dropped sharply within days. This initial crash is driven purely by emotion, fear, uncertainty, and the human instinct to protect what we have. For retail investors, this is the most dangerous moment, because panic selling locks in losses that may never have needed to happen. Here is something that does not make headlines as loudly: markets almost always recover, and often much faster than people expect. Looking back at World War II, the American stock market actually began recovering well before the war ended, as the massive industrial and manufacturing boom began to drive corporate profits. After 9/11, US markets fully recovered within a month. After the Russia-Ukraine conflict began in 2022, Indian markets, which had fallen sharply, bounced back within weeks and went on to hit new all-time highs later that year. The pattern repeats across decades: initial crash, followed by recovery, followed in many cases by a bull run. Why? Because economies adapt. Governments pump in liquidity, central banks cut interest rates to stimulate spending, and defense and infrastructure spending creates enormous economic activity. For the patient, long-term investor, wars have historically been buying opportunities, not exit points. Not all sectors of the stock market behave the same way during war. This is where investors pay close attention. Smart defense and aerospace companies almost universally benefit from wars, as governments dramatically increase military spending. Energy companies, particularly oil and gas, tend to surge because war in key regions like the Middle East disrupts global supply chains and drives up crude prices. Gold and other precious metals also rise sharply, as investors flock to safe haven assets. On the losing side, aviation, tourism, hospitality, and consumer goods companies typically suffer. Supply chain disruptions hurt manufacturing and technology companies that rely on global components. Banking and financial sectors become volatile due to currency fluctuations and sanctions. For Indian investors specifically, sectors like FMCG and pharmaceuticals tend to remain relatively stable, as domestic demand does not disappear during global conflict. One of the best ways to gauge market mood during war is to watch the VIX, the volatility index, often called the fear index. When the VIX spikes, it tells us that institutional investors are buying protection and bracing for wild price swings. During major conflicts, the VIX routinely doubles or even triples. Another critical factor for Indian markets is the behavior of foreign institutional investors, or FIIs. When global uncertainty rises, FIIs pull money out of emerging markets like India and park it in US Treasuries or gold, considered the safest assets in the world. This outflow weakens the Indian rupee and puts pressure on domestic markets. Domestic institutional investors, or Ds, often try to absorb this selling, but they cannot always fully counteract fee exits. Understanding this dynamic helps Indian investors avoid the mistake of thinking that a market dip caused by fee selling reflects the actual health of Indian companies. The most important advice during wartime market volatility is deceptively simple: do not stop your SIPs. Systematic investment plans are designed precisely for times like these. When markets fall, your SIP buys more units at lower prices. This is called rupee cost averaging, and it is one of the most powerful tools available to retail investors. Second, review your portfolio diversification. If you are heavily concentrated in sectors that are war sensitive, consider rebalancing toward more defensive sectors. Third, avoid the temptation to time the market. History shows that the biggest recovery gains come in short bursts, and missing just a few of those days by sitting in cash can dramatically reduce your long-term returns. Finally, keep 3 to 6 months of emergency savings in liquid form outside the market. This gives you the financial security to hold your investments without being forced to sell at the worst time. War is terrifying. Its human cost is immeasurable, and its economic ripple effects are real and painful for millions of people. But the stock market, across more than a century of conflict, has shown an extraordinary capacity to survive, adapt, and ultimately recover. The investors who have built wealth through wartime are not the ones who predicted every move. They are the ones who stayed calm, stayed invested, and trusted in the long-term engine of human economic activity. At Consumer Times, we believe that knowledge is the best shield against financial fear. Understanding what war does to markets does not remove the risk, but it removes the panic, and that alone can make all the difference to your financial future. Like and subscribe to Consumer Times for more content that puts the power back in your hands. Keep investing wisely, keep watching Consumer Times, and remember, in the long run, steady hands always win.